How many times have you heard that whole life insurance is just too expensive and that you should get term insurance instead? Well, stick around because today we're actually going to do the math, and I think you'll be surprised what we come up with.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're talking to you guys about why term insurance is more expensive, or at least that's the rumor. Anthony, what are your thoughts on this?
I would say a lot of times when we look at it, you would think, well, for the same death benefit, the premium's much higher than it is for term. But we there's more to the equation than just the premiums, and that's what we're going to discuss today.
Absolutely. And in preparation for this podcast, what I did is I just did a quick Google search, right? And I think that a lot of some of the myths in personal finance stem from half-truths. I think we've talked about that before. And so what I did is I did a quick Google search, and the first thing that came up was a Forbes article. And I read it, and I pulled out some of the nuggets.
Let's hear the nuggets.
Yeah, they were good ones. First, there's 4 things I'm going to share with you. My favorite, or not my favorite, I'll save it for last, but it says, first and foremost, that term is a better choice. Whole life is considerably more expensive. Whole life is a terrible idea. And then my favorite was, some people need it. For them, it may be worth it. So if you've ever read a biased article, you can pick up on some of the wording, right? I don't think that that's fair in any way. Today, what we're going to talk to you guys about is kind of the difference between price versus cost. And there is a role for term insurance. So we will address that at the end.
Yeah, we're not bad-mouthing term. I have a couple million on term on myself.
I have a couple million and 10,000.
Yeah, term has its place, right? But a lot of times we're focused on the death benefit piece. And, here at Infinite Wealth, we design these policies not for the death benefit, but because all the things you can do with the cash value. However, we're strong believers not only in IBC, but in whole life and the truth. And when there's things that come out that are half truth and that are negative against whole life and IBC, we are going to address them. And look, IBC everything has its pros and cons. IBC is no different, and we even had podcasts of the 5 reasons not to do IBC, or the 3 biggest downsides of doing IBC. We're very transparent on that. But I will tell you, you were doing a quick Google search. I went and did a bunch of these illustrations and kind of did all the math. So
thank you for that, Anthony.
But I would say, when I got excited about when I was going through this, because at first we talked about, talking about costs or the premiums, but man, there's so much more to it.
Yeah.
And I get so passionate about infinite banking and whole life. And then when I hear stuff like this from Forbes, it's really full of half truth. And what we're going to do today is we're going to peel the curtain behind, and we're going to compare the two. And then we're also going to talk a little bit about how infinite banking fits in there.
Absolutely. Anthony, thanks for doing all the heavy lifting. I'm going to be and highlighting that for our listeners. Thank you. I'm going to be asking you questions. You're going to dive into some of these illustrations. And for those of you that are listening on the podcast, Anthony's going to be sharing the screen and going through some numbers. So stick around. If you guys have a chance, maybe this is one that's better suited to watch on video.
Yeah. Well, that's a great point. Is in order to we have a lot of content on our YouTube channel. Not only do we post the videos of the podcast, not only can you hear Cameron, but you can see that silky smooth hair, right? But there's also going to be some additional resources there. Oh, let me do another plug. Is when we have a podcast interview. If you've kind of noticed, the podcast 50-50, Cameron and I, and then 50% we have guests, whether they're talking about infinite banking or ways to create passive income or to save money in taxes. When we have an interview, we're live streaming that on YouTube and Facebook. So if you subscribe to our channel, you will get notified of when those are coming up.
Great point, Anthony. Let's dive into these
Let's do
numbers.
it.
Anthony, tell our listeners how you came up with the illustrations that you're going to be sharing here.
No, I will say, there's a lot of different ways that we can design these policies. And so we had to make a couple of judgment calls of how we were going to compare. And so what we're going to do on this first one here, let me share the screen here. But if you're listening to it while you're driving, I will be speaking through of what it is we're looking at. So example we decided to choose is a 35-year-old that only needs death benefit until they're 65.
Okay.
Right? How many gurus are talking about that?
One big one that I can think of.
Okay. I would encourage you to ask anybody you know who's over 65. Ask them if they wish they had death benefit. Okay. So, but anyways, so what we're going to do here is we took a 35-year-old male. And again, there are different health ratings. We wanted to be more conservative. And so we are going to do everybody, or in these comparisons, are going to be at standard. And I chose 20,000 a year as what we're going to put into these premiums. And just remember, these are all relative, right? If you only want to put in 10, then it is all the numbers are going to be half. And so what we did here is, as I scroll down, if you look at on these numbers, we have the premium that we are putting in. We have the cash value. And then this column here is one of my favorites. This is a change in net cash value less the premium. Because one of the downsides of whole life is what we call a slow start. Right at the beginning, you put in $1, you don't have access to a whole dollar. And if we look at the first 3 years, we're a little bit negative, meaning we put $1 in, we don't have a full dollar. But however, at year 4, we do, meaning our cash value is increasing more than our premium. And we call that cash. When does the policy cash flow? Meaning dollar in, dollar out. And so this only occurs for the first 3 years. Now, one thing I like to say is there's a lot of different ways that we can design this.
I see that. And what I would note here is that you did not get my input on this design, because this is not IBC. This is a little more conservative, huh?
Well, no, what I wanted to do is be able to put in the full 20 the entire time.
Okay.
Now, what we could have done is I could have made this slow start smaller, but by doing that, we wouldn't be able to put in 20 grand a year. But maybe at some point, because of the MEC line, we wouldn't be able to put in the full premium.
Gotcha.
So
okay.
Again, what I wanted to do is you shouldn't be doing IBC based on the numbers of the illustration, right? The illustration is just part of it. We could have made this look nicer. I mean, I could have put them at preferred. I mean, I could have designed it a little bit differently, but again, whenever we're looking at this, we want to show illustrations that we know we can make better if the client wants to. But as one of the podcasts we did a couple of weeks ago, when we interviewed Todd Langford, one of his famous lines, which we always credit to him, but he had said that he gave credit to somebody else.
Daniel Pink, I think.
Yeah. But he said, there's no deals in life insurance, right? Life insurance or whole life insurance they're using actuarial science. So you get a little bit up front, like there are some high early cash value policies. They have high early cash value. However, you're giving up something. You're giving up late cash value. So we're not big fans of focusing on the short term. We want to focus on the long term. Okay. So if we were to add what were negative the first 3 years, it's about 18,600. Let's just round it to 19. Okay. And what I think it was one of your clients, Cameron, she had said, hey, the way that I view this is that 19,000, I'm prepaying for my death benefit. So she's paying $19,000 up front. She has over $1 million of death benefit from day one. Now, as you can see with whole life, it's designed where the death benefit is going to get larger. We look at year 20, the death benefit is not 1.1 million. It's almost 1.6 million. And we go out to age 30, the death benefit is 2.2 million. So term is going to stay constant, but whole life is going to increase every year. So the difficulty or judgment call we had to do is, well, how do we compare a static death benefit to one that is increasing? And Cameron, you actually did give me some help on this. And, what we're going to look at is the cash value. We're looking at this to year 30. Cash value is 1.2, death benefits 2.2.
Mm-hmm.
So I won't have you do the math, Cameron, but that is a difference of $1 million. And the way that we're viewing this is, in fact, let me go back up here. Cameron, I'm going to ask you a question. We can see in year 4, we're putting in 20,000. Cash value grows by 20,700.
Mm-hmm.
So if you put in $1 and you can turn around and pull out that exact same dollar, Cameron, how much would you say that this policy cost you that year?
I'd say it costs $0.
It costs $0 because you got all your money back, right? So one way to look at it is it cost me 19 and I got $1 million. I got the death benefit. Then after that, every dollar I put in, I'm going to have more and more. So,
before you move on, Anthony, I don't know if you're going to share this, but if you look at year 4, you're talking about kind of your year over year.
Mm-hmm.
Also, I was looking at your cumulative, and it looks like in year 8, you've got everything available to you that you put in. So total premiums 160, cash value is 162. So again, you'd mentioned that cost that client was looking at in the first couple of years.
Mm-hmm.
I would also argue that by year 8, there really is no more cost, right?
Yeah.
Yeah.
Well, I'd say there's a lot of ways that we can look at it.
Yeah.
I look, well, we're going to take it even a step further. And I'm going to say that this is death benefit costs you nothing.
Okay.
Right. But I don't want to steal my own thunder. Right. So Cameron, but what I'm hearing is you're saying that, hey, I'm putting in these premiums and I'm getting cash value back. Right. So a lot of ways we can say that this didn't cost much, or even your client viewed it as costing 19,000. Right. But if we compare this to term, for $1 million term policy for 30 years, it's going to cost about $1,500 a year, which is $45,000 over 30 years. So the question is, which one costs more? Right? We have term, and we spent 45 grand that we're never going to see again. And now in a whole life, our premiums were a lot more, but we get all the cash value back. And if we look at age 65, we've put in 600,000 premiums, have 1.2 million in cash value. So you're actually plus 600,000. You got all your money back plus some. And compared to term, you are out $45,000. So Cameron, I'm going to ask you this math question. Okay. What's more expensive, paying out $45,000 or getting all your money back plus some?
$45,000 cost.
Right. And so we got to look at really the whole picture. I mean, most of the time when these Forbes articles, they're just looking at a small window. And also the way that they're really comparing things is more of a typical whole life policy. Ours is designed for cash, because we want to be able to put that cash to work. Because I would tell you the only thing, because here's what else I think is pretty cool. not only do we have all the money back plus some, but if we look, we still have death benefit.
Mm.
We still have cash value. And if we look at year 66, the cash value grows by $62,000. Now, what's the tax rate on that, Cam?
0.
0. So this I did do the math. That's 5%. This grew by 5%, tax-free, no management fee, right? And also, while we put all this money in, we also have the ability to turn it into tax-free cash flow. And I ran this as how much cash could we take out at age 71? So we're not putting any more premiums, but now instead of putting money into the asset, we start taking it out. And we can take out $88,000 a year. And Cameron, what's the tax rate on that?
0.
0, right? And I ran it as if we had died at 95. So we would have taken out about $89,000 a year tax-free, and we would still have a death benefit of almost $500,000. What, when this person's 95, if they would have gotten term, how much death benefit would they have?
0.
0, right? So we have all our money back plus some, and we still have a death benefit. But what we're looking at here, Cam, this is just whole life.
Mm-hmm.
This is just an efficiently designed whole life policy. But this is an IBC.
Good point.
Right? We incorporate infinite banking. Now, Cameron, as we're going to see here, at year 3, we have a cash value of $41,000. Could we not leverage that? Again, we're not going to withdraw the money, but we're going to borrow against it and put it as a down payment on a rental property. And you can do that for as little as $25,000 down. So could we not buy that cash flowing asset, use that cash flow to repay the policy? Now, you have a good tenant, you might pay it back there sooner. A not so good tenant, it may be longer, but eventually you should be able to use that cash flow from that asset to repay the loan. And here's the thing. Now, Cameron, in this example, in year 11, we have $252,000 in cash value. Now, if we would have loaned against it in year 3, paid it all back, how much cash value should we expect?
252.
252. So here's the deal. You're going to have 252 in there anyways. But if you incorporate infinite banking and you use it to buy a cash flowing property, you are going to have both, right? And I kind of ran this, we could buy a house in year 3 for 25 grand, but in year 4, we have 62 grand. So when we have enough to buy another house, Cam,
Mm-hmm.
and then in year 5, we could buy another house. So if we were to buy a house every single year, we would have 27 homes or 27 assets. Okay. And we still have the same amount of money inside our policy. Right. And what I also thought was interesting, I'm going to have a lot of and thens.
Yeah, there's a lot.
Right. Because if we look here at year 21, cash value grows by $50,000. So again, I'm going to I hate to put you on the spot, but doing math, but would we not be able to buy 2 homes that year?
Yeah. Thanks for not asking.
Right.
Yeah.
Okay. I didn't want to put you on the spot. So we could buy even more homes.
Mm-hmm.
Right. But so I don't even know how many homes or how many assets that we could buy. But the thing here is here's a cool point I want. Here's another and then.
Mm-hmm.
Okay.
You're like Ron Popeil.
Yeah. Well, I was thinking more, Dude, Where's My Car? I don't know if you saw that. And then, did you see that movie?
No, I did not.
Okay. Classic. Okay. Classic. But the Dude, Where's My Car?
Threw you.
It threw me off.
Threw you.
But I tell you, we get a lot of people that will say, hey, I hear whole life's terrible. I don't need the death benefit.
Mm-hmm.
I don't want that slow start. I just want to buy assets, and I get it. And if we were to compare doing IBC or or using cash, let's just say that we're going to set aside 20,000 a year to buy assets. If you're using cash, the most you can buy each year is 20,000. Right. But you can see here, because of the power of compounding, we can buy more each year. We're showing here, we're buying a house of 25, and eventually we can buy 2 houses of 25. But because you have that power of, we're never breaking that compound interest curve, you're going to be able to buy more assets, which will increase your returns. And that's why the way that I look at like this 88 or this cash flow in retirement, that's my rewards credit card. I view my policy as my rewards credit card for my investments. I'm going to buy it anyways. By adding one extra step instead of my credit card and getting miles, I add my policy and I get uninterrupted compound interest. And then really at the end of the day, when I cash in my rewards credit card, it's going to pay me $88,000 a year till I'm 95, income tax free. So
not bad. Well done, Anthony. Well done. Great point. Right. Again, I think it's a unfair comparison when people are comparing whole life and term. Anthony did a great job of kind of comparing all the benefits that can be found in whole life. Right. We get all of our money back and we have the ability to leverage against it.
And this is why I get so passionate about infinite banking, and whole life is a great asset. And then you sprinkle infinite banking on that, man. I'd say I'm getting fired up. I can't even talk. But then when I hear like this bad mouth or like Dave Ramsey, it fires me up. Like, it's just not true. Let's do the math.
Yeah. Man, I do have to give you credit. You've been fired up about this podcast for a couple of days, and I've just kind of been, all right, yeah, this sounds good. But well done. Well done. Well, as you were talking, what came to mind was a client that I spoke to recently. I think I already shared the story with you just in passing, Anthony. But again, just as a reinforcement that what we're not saying is that term life insurance is terrible, right? They're completely different products, and there's a place for both of them. And so I was going to share with you guys just a quick story is that a gentleman called in and he was actually looking at us using IBC, using a whole life policy for IBC. And he's also looking at somebody else that was recommending an IUL. And so we talked for a while. We actually spoke 2 different times. The first time he called in was more of an introduction. Second time, we really got into some of the numbers and his situation. And what it came out to be was the guy made good money, right? And the other company was telling him, hey, here's exactly what your premium should be. This is what you need to put away. And I talked to him for probably close to 2.5 hours in those 2 conversations. And he asked for my advice at the end of it. And my advice to him, Anthony, was, I don't think you should do either.
How come?
The reason was because he had 2 different opportunities that were in front of him. One is he was trying to buy a residence, a personal residence, he's trying to buy a house. Then also the second one is he was buying into a business. And so what I told him was those are the 2 priorities at this point, and that the IBC, the whole life, should be that third option for him. And so I told him that it was just too much at this point. And if anything, what he should do is just buy a term policy, acquire the house, get into the business, and then focus all of his efforts on that business and getting that revenue up and going as quickly as he can. And with that revenue, then you start a whole life policy. And so that's kind of how we ended it. And the guy ended up back on my calendar about a week later. And I'm like, hey, Brian, I didn't think I'd see you. All right. Good to see you again, man. And he's like, hey, I actually really appreciated your advice. He says, I felt like it was very prudent after I kind of stepped back and looked at my situation. He said, I would like to move forward with that term policy, and that's what I'm going to do. And so I thought that was a good story to share here. Just let you guys know that there's certainly a place for term insurance. I carry a bunch of it just personally, and most of our clients carry a term policy as well.
Yeah, I carry it because I want to protect my family, right? But also I'm tired of getting examined again.
Mm-hmm.
So when I'm ready to get another policy, you have that term policy. You don't have to go through underwriting again. You're already improved. We can easily convert that into an IBC policy. And Cameron, what is interesting, the story you just shared reminded me of a story.
Mm-hmm.
I'm not saying it's better because this is not a competition, but it's similar, but a little bit more, where we had a client who actually spoke to another IBC firm. And this client is saving $2,000 a month and he has 30,000 in cash. So they're like, hey, let's do a policy, 2,000 a month, 30,000 dumping. Kind of sounds great, but the problem was he wants to buy a house. And so in the meantime, he's living with a family member to save money on rent. So his rent or his overhead is temporarily low. Once he gets that house, that 2,000 is going to be is what he's adjusting for his mortgage. So he won't be, and that $30,000 is the down payment of the house. And he recently just bought into a business as well. So his income should go up, but right now it's, it's going to take a little bit. And we got on the call and I'm like, you know what? To be honest, I think maybe we should get some convertible term right now. Like the money you're saving, that's earmarked for an asset. And so the bottom line is the assets are the priority before the policy. But what was interesting is he's like, well, I don't want, he goes, you know what? I'm also saving an extra $1,000 over here. So I'd like to use that and have a whole life policy. And then the way we're able to design it is he's putting in the $1,000 a month, which he can afford now, but we're building in room. So when that room for additional deposits, so when that business starts to mature and he can start taking some distribution, we already have a place set up for him.
Great story.
Just a little bit.
Great story.
It's not a competition.
Yeah, it's a good thing it's not, because that would have been second place. But well done.
Well, what the point would be, and I love interrupting you, right? Is if you want to see if IBC is for you or have some questions about whole life, get on a discovery call with us. We'll talk about your goals, answer your questions, and give you the proper advice. Just like you'd mentioned, Cameron, we're not always pushing people in to get whole life. Sometimes the time's not right. But if it's not right, we will be the first to tell you. So the link to schedule that discovery call will be in the show notes.
Awesome. Great point. Guys, I hope this was helpful to you, right? There's a lot of misinformation out there. Anthony was able to share some numbers with you, and hopefully you guys can see some of the differences between term and whole life. So again, hope this was helpful, and we'll see you guys in the next episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.